All right, how's it going, everybody? My name is Antonio, and I'm back for some resource talks today. This time with Rick Rule. We spoke on October 30th, and him and I talked about the energy space as a whole. So yes, uranium was most of it. We talked about what did we talk about? We talked about Cameco at length. So Rick's comments there were not surprising, but still interesting, and well, maybe surprising to some of the listeners. Uh, that led us to talking about which other uranium companies he's still bullish on and which ones he still owns. And more importantly, we actually talked about why he still owns them, meaning how does he calculate the value of those companies given that most of them are not producing any uranium yet. And so how does he know that they're not overvalued yet and still worth holding? So we we mostly talked about the developers there, and Rick also talked to me about the three risks to the uranium thesis. So yeah, he said there's three. I thought there were fewer, but he disagreed with me, so that was interesting. After uranium, he talked to me about other energy commodities, so natural gas, oil, coal, because I basically asked him what he thought was today what uranium was when him and I first spoke about it it must have been 2019 or 2020. So we didn't quite get to silver. It was mostly energy that we spoke about, but he did mention it once. Rick did get called in earlier though, so we had to stop recording prematurely. But at the end, I've added a clip from a prior discussion that I had with him where he explained to me how exactly he deals with buying and selling stuff that's hated, that's out of favor, if you will, and more specifically, how he weighs the probability in his favor. Like how does he make sure that it's not too early or that in the end he's not going to lose money? Or like how does he optimize the probability and not make sure, because you can never be sure, of course. But obviously you didn't come here to listen to me, so pause the screen right now. There's probably something on your screen, a disclaimer, a warning. Read that warning if you don't like losing money, and after that we can listen to Rick Roll. All right, Rick. So well, first of all, thank you for being here, obviously, but it's been, what has it been, 2 months? How have you been? How are things going?
Life is great. As you know, I completely failed retirement, and I'm very happy about that. So it would be difficult for my life to be better. Thank you for asking.
I saw your governor also went to China and tried to mess stuff up as well, so you're probably happy about that.
My former governor,
Yeah.
I decamped the People's Republic of California. I now live in Washington. When I heard he went to China, I was hoping the Chinese would do us a favor and keep him. Uh, that we were not so fortunate. He was returned to the People's Republic of California. But as I say, I'm no longer a prisoner there. We have our own governor up here, Inslee, who I call Grimsley, who is cut of the same cloth as Governor Newsom, which is to say, I don't like either of them, and I would prefer that they both went to China, hopefully for keeps.
But do you ever like anybody in the government?
I like a few people who have run for office. I remember years ago a friend of mine running for Senate in West Virginia. He was asked by New Yorker magazine what he would do if he won, and he said, "I would demand an immediate recount." Uh, I have a sense of humor for that.
Yeah, it's its own world out there. I don't necessarily know too much about it besides seeing the memes out there. That's how I try to stay up to date with politics, because it's more of a circus than it is reality these days. So
Well, the fact that you don't know much about it speaks to your apparent honesty.
how come?
If you knew about it, if you were a practitioner, it would be proof that you believed in enslaving your fellow citizens.
Hmm.
The fact that you don't know much about it means that you haven't spent much time learning how to oppress others, which is a good thing.
I've spent some time watching some of the interviews you've been doing recently, though, and it's they're all like they always start sort of the same way with a broad market overview, and then the host is going to ask you whatever they think is going to get them the most eyeballs on a headline. I don't blame them. I do that too. But what do you care about? What do you want to talk about?
Well, a few things are of interest to me. We have talked from time to time over the last few years about uranium. And I think talking about what happened in the uranium market and why is a good thing.
Hmm.
We could talk about energy markets, which we've also talked about, both oil and gas and coal. and the fact that when we talked about them, those were inevitable outcomes too. And we could talk particularly to a European audience about why Western politics, but European politics in particular, guarantee that fossil fuels will do well in the future. You asked me before the cameras rolled what commodities I felt were still hated and unloved. And I think as a consequence of that, we might talk about silver too. Talk about its positive attributes, which is to say nobody likes it. The unpopular should always be focused on, but also talk about the fact that as a speculation, it's fundamentally different than uranium was, and why. And I think perhaps also, although your audience is mostly younger and they'll mostly ignore me, we should talk a bit about portfolio allocation, the allocation between the stocks that I consider to be beta stocks, where you're buying a sector for the sector outperformance relative to the broad market, versus alpha, where you're looking for stocks, by my definition, that outperform not just the broad market, but the sector, and the risk allocation between beta and alpha. So as much of that as we got through today would be of interest to me. I will happily, of course, talk about anything that you think that your listeners are interested in. And if what you want to do is use me for clickbait, I have a sense of humor for that too.
Well, I'm looking forward to the next 7 hours based on those topics here. So let's maybe combine one of those topics that you said about beta versus alpha, and also uranium, because I made a post a few days ago, jokingly, but only half jokingly, because it's really mostly painful when I look at the portfolio. But I talked about the realization that since you and I first started talking about uranium, it must have been 2019 or 2020, I could have just bought the most obvious thing that was out there. Cameco was just a very obvious bet by almost any metric, and forgot about it and just enjoyed the dividends and also made money on the capital gains. But instead, I sort of over-engineered my portfolio. I picked the wrong subset of the market to average up in. That's also something I did wrongly. FOMO on the way up. Into specifically, moose pastures. So clearly, I was in the right place, and potentially I was buying the right stuff, but at the wrong time and executed it wrongly. And so what I'm thinking now is, what subset of the uranium market do you think is next to follow in Cameco's footsteps? Like, is it developers, or is it already time for those moose pastures?
The next portion of the market will be led by Cameco.
Again?
Yes, because of tailwinds. What's important to know about Cameco is, first of all, that the generalist money isn't in uranium yet. And when the generalist money comes into uranium, it will look for the biggest, most liquid name. You don't get fired for buying Cameco. You get scolded. You get fired for buying Consolidated Moose Pasture. And from a business point of view, Cameco has the ability to increase production, not from greenfields, but from restarts, which don't need to be re-permitted. And because the physical market for uranium has gone from 80% spot to 80% term, the structure of the market has begun to favor Cameco. Cameco, because they're an existing producer, can enter into term contracts with investment-grade counterparties and lock in minimum revenue levels for the next 5 years, 7 years, or 10 years, their choice. In other words, rather than selling uranium at $75 today and seeing the price decline 3 years from now to $40, as an example, they can lock in uranium today with a floor price of 70 and escalators up based on market. And they can use that contract with investment-grade counterparties to, first of all, lock in the revenue from their future production, but also to finance the restarts. Companies that aren't producers don't have the ability to do that. And so Cameco's cost of capital is going to be a third of the cost of the capital for their non-investment grade competitors. The reality all favors Cameco. Now, that isn't to suggest that Cameco will be the best share market performer. It suggests it'll be the best risk-adjusted share market performer. What was interesting to me about the 2019-2020 mini uranium bull market, the false start, was that for the first time in my life, the escalation in commodities-oriented companies wasn't led by the highest quality company. In prior bull markets, the biggest and the best move first. Well, the commodity moves first. Then the biggest and the best move. Then the second-tier producers move. Then the developers move. Then the explorers move. The 2019-2020 was the first meme commodity bull market I ever saw. What that meant was that the TikTok crowd, not the TikTok crowd, pardon me, the Reddit crowd moved into uranium. And rather than having Cameco move first, Consolidated Moose Pasture moved first. The narrative was if the uranium market was to go from $20 a pound to $50 a pound, when that happened in the 2002 bull market, by 2004, all of the tiny companies had gone up tenfold. So you had a narrative market in uranium, which I've never seen before. It didn't last, just like the narrative market in silver didn't last. But it did change my mind as to how I orient some of my portfolio. My suspicion is that in the bull market in uranium to come, I will still want to be 75% allocated in the best names, Cameco and Kazatomprom. I overweight Cameco, although Kazatomprom is a better company, because I understand that institutional investors in the developed world won't be able, either psychologically or legally, to buy Kazatomprom. So the money will come into Cameco, and Cameco will enjoy a lower cost of capital than Kazatomprom. I also own the highest quality of the developers' names. When I say I own, I haven't reduced my positions in them. So I own Nexgen Fission because I think that's the best development stage property if you combine them that isn't controlled by a major. And I think in this cycle that gets taken over. That is to say, both Nexgen and Fission get taken over.
By one party?
Pardon me?
By one company?
Yeah, I think so. It should be built as one deposit. It might not be,
at least
but it
one
should
mill.
be built. It should be built as one deposit, one set of infrastructure. You know, it's 500 Ks from anywhere, and so you need to build a power source. You need to build a camp. You need to build all kinds of stuff. It would be better to build one, not two. Doesn't always happen, but that should happen. And it likely has to be built by a Canadian or at least a Western company. I don't think the Canadians will let the Chinese build it. So it'll be a Teck or a Cameco or a BHP or a Rio that ends up building it. But anyway, I still own those. In the smaller companies, I've now sold enough that I've recouped my bait. You know, if you have a sector that is moving to heaven but hasn't yet achieved heaven, the idea that when the sector triples, that you don't sell some and recoup your capital is stupid. So across the board in the names that I was attracted to, a year and a half ago, I've recouped my capital and sold enough to pay the capital gains tax. I'm keeping the rest because although I believe the easy money has been made, my suspicion is over the next 2 or 3 years, the big money will come. The speculative blow-offs are always where the stupid money gets made. I prefer, now that I'm 70 years of age, to make smart money rather than stupid money. But I do like having some exposure there. The top of the bull market, when it occurs, probably 3 years from now, we'll see the penny dreadfuls. the Explorer Cos that have had interesting hits but don't have a deposit, the promotionally oriented companies that, were they in business 3 years ago, would have misspelled uranium. You'll see those companies do well. And I likely won't participate in that. I'm too old to want to take the risk associated with a bunch of companies that go 10 for 1 and then reverse course. I'm not interested in round tripping on speculations anymore. I'm not interested in companies where my making money requires somebody to be substantially more stupid than I. I found occasionally that I was the dumbest guy in the room waiting for somebody dumber. I don't want to do that. But I think it's important that people who listened to our uranium discussion a year and a half ago and didn't ask themselves why they didn't act. Even more, people who bought uranium in 2020 after the stocks had tripled in price and then sold them in 2022 when those same stocks were selling at half price and hence were twice as attractive arithmetically. People need to examine what it is about their thought process that allows them to underperform so dramatically in a market where the outcome is so certain. I think those are very, very important lessons. It's important if you're going to be a speculator, particularly a speculator in commodities, where they're capital intensive and cyclical, where the outcome can be known. It's important to buy commodities that are hated. It's important to buy stuff that's out of favor. It's important too, when you're right, and some of the hate disappears, that you monetize the arbitrage between hate and normalcy and hate and love. It's important too that your listeners pay real attention and revisit the phrase that you and I used with regards to the uranium market a year and a half ago, which is to say, the outcome is inevitable, but it isn't necessarily imminent. Speculating in questions where the answer begins with when, not if, are very good speculations, particularly when there's the overlay, the patina of hate, and you don't have any competitors.
There's lots to talk about there. Very kind of you to call them promotion-oriented companies. There's a couple of other words that you could have used to describe some of the companies I lost money on. But it's interesting you should mention Rio too, by the way, as a potential acquirer of the western side of the basin. I'm paying close attention to that side of the basin too, because it used to operate before. It was a nice spot, then it sort of died off, and nothing is really happening there. It seems like it should be. And I've heard rumors, and it's really rumors. Don't sell your wife yet, but it's I've heard rumors that Rio is sending people up there. They're seeing, those trucks pass by, or I believe they have like buses that pass by with logos, and they're sniffing around. And I don't know if there's a worse uranium trader than Rio Tinto, but they've done some bad deals in regards to uranium. So it'd be interesting to see them come back. Yeah. What about valuations though? Like on Cameco, like when you talk to me about Cameco, and it trust but verify, I suppose is prudent. And like when you look at the financial ratios on Cameco now, it's nothing like they were in 2020. And PEs and whatnot are really high. How do you justify that, or how do you even value a uranium company given how different this sector is?
The PEs, first of all, are trailing PEs, so they're based on much lower uranium prices. They're also based on a company that has 35% of its production hot stopped, which means that they've shut in the production, but they've maintained the ability to turn that production on in a fairly short period of time. Importantly, a year and a half ago or 2 years ago, Cameco was a price taker. But the structure of the uranium market has changed from being 80% of the transactions in the spot market to now 80% of the transactions in the term market. And whereas the spot was $45 when we talked, or $40 when we talked, the term is now $75. So Cameco has the ability as an existing producer to enter into term contracts, 5-year terms, 7-year terms, 10-year terms, sometimes 15-year terms if they want to, pledging their existing production and using those contracts to acquire very low-cost capital to restart their hot-stopped projects, increasing their production by 35%. But importantly, controlling their revenue going forward. They're no longer subject to the vagaries of the spot market. They can lock in for as much as 70% of their production, minimum guaranteed prices from investment quality utility takers for the 5-year term, the 7-year term, or the 10-year term. Doing this at once increases their production substantially. It also locks in higher top line numbers, and it locks in an economic margin. And it gives the securities analysts the ability to get some certainty with regards to the financial performance looking forward, which was solely lacking from Cameco. Now, I'm not trying to say that if China experiences a real slowdown and we go from 40 reactors under construction to having 20 reactors under construction, that the escalation in price in Cameco won't hit a hiatus. I could find 2 or 3 things wrong that might disrupt the thesis, but life is about probabilities, not certainty. People who require certainty should probably consign themselves to a future of certainly losing money on bonds.
I've been joking about this for so long. Bonds just only seem to keep going down. So it's that. But you can't tease me like that. 3 things that are wrong with the thesis. What are 3 things? I know about, potentially another Fukushima, but what else?
Well, another Fukushima would be the worst. Another Fukushima would set back the uranium industry 15 or 20 years. I would say the worst risk we face in Cameco is certainly a synchronized global recession that reduces demand for 5 years or 6 years or 7 years for power. We have a really ugly supply deficit in uranium, but you can have reduced supplies if you have reduced demand, and the price doesn't have to go up. You could also have implementation risk. One of the problems at Cameco is that one of their deposits is technologically very, very, very tricky. You have to freeze the sidewalls of the deposit to prevent freshwater incursion into a highly radioactive ore body. And that requires real precision mining. It isn't knowledge that you can buy off the shelf because Cameco developed it, and Cameco has to implement it. So some of that return to production requires very, very, very high skilled mining. And it's possible for me to see implementation failure there. It's important to note too, though, that in Cameco, you had some write-downs that had to do with material that when the price fell below $40 wasn't economic. Now that the price is at 75, that material, which is on the balance sheet for free now, is economic. And it's economic without getting a permit, without building a mine. It's economic because it's on concession in deposits that have already been built.
So it's easy when you explain it that way. How would you then go about valuing some of the other companies, maybe even some of the ones that we just talked about? I'm hoping we're going to get sort of to talking about your rankings too, but is that because there seems to be a discussion online
because Atomprom is cheaper than Cameco.
Sure,
and I think it'll continue to be cheaper than Cameco. So go ahead.
I meant more like the companies that are not making any money right now. Companies the developers that have a deposit, and that I'd see sometimes people or companies valuing themselves based on EV to pounds in the ground, and that's a very misleading metric, if you will. So
that's really stupid. It's stupid, except that speculators pay attention to it, so it becomes a self-fulfilling prophecy based on an irrationality. I'm not very good at speculating on stocks that way. I don't own a television set. I can't dress myself. So attempting to value an incorrect narrative isn't something that I can do. But there are other people who are more tied into the popular culture who could, as an example, anticipate a meme narrative that might do well at that. Uh, the two development stage companies that I still hold large shareholdings, and in fact, 100% of my shareholdings, are Nexgen and Fission. In the case of Nexgen, I have a feasibility study. And what I do is plug in cost of capital, which is to say interest rates, and I plug in term contracts. In other words, I change the variables on the feasibility study, and I do my own net present values. It doesn't mean they're completely accurate, but no feasibility study is ever completely accurate. What it gives me is a range of probabilities. With Fission, I don't have that feasibility study, feasibility stage study yet. But I do the same work on a pre-feasibility study. I'm able to approximate the capital cost to bring the thing in production. I'm able to anticipate what their likely cost of capital will be. I'm able to use the study numbers in terms of what the annual production will be, what the production cost will be, and I'm able to do a net present value of future cash flows. I assume in those two, and this may be an incorrect assumption, that neither Nexgen nor Fission will be able to build these deposits. I assume that someone will have to take them over and build them, and that they'll be built together. I remember I made the same assumption with the Canadian diamonds, and amazingly, two major multinational companies built diamond mines 19 kilometers apart and duplicated all of the infrastructure themselves, wasting $600 million of their shareholders' wealth. I'm thinking and hoping that that mistake doesn't need to be repeated. And the one buyer buys both of these companies, that buyer is a buyer with an investment grade balance sheet so that the capital cost can be financed on budget, on balance sheet, pardon me. And that buyer has the financial strength to enter into term contracts. If I do that and I use a $75 base, I'm very comfortable personally owning both Nexgen and Fission. What could go wrong? Stupidity. Nexgen and Fission could continue as separate companies. They could try to finance and build their own future with a much higher cost of capital. Or they could make deals with separate majors. One of them could make a deal, as an example, with CGN, China General Nuclear, which is a very, very, very fine company, but probably politically unable to build a uranium mine in Canada. So these are speculative. What they are is my assigning a probabilistic size of the prize, and then working backwards to assign probabilities around the size of the prize. And I give myself an upside case too. The upside case has to do with the fact that with the robustness of the term market and with so many nuclear power plants planned and in the financing stage now, the developers of these nuclear power plants, when they go to obtain the project finance, are increasingly required by the lenders to secure enough uranium in the term market that they'll have access to supplies for long enough to amortize most of the term loan. Which is to say, if you're building a new reactor in China and you're going to Industrial Commercial Bank of China, they are requiring you to obtain 60 or 70% of the uranium that will be required for the plant for 15 years to amortize half the loan. And it doesn't really matter that much to a power plant producer whether he or she pays $75 a pound or $100 a pound. The reason it doesn't matter is because the uranium cost is between 3 and 5% of the total expense on an annual basis of maintaining that plant. if you have $6 billion to build a plant, let's say you've borrowed 75% of it. So you borrowed $4.5 billion, and that plant is burning 2 million pounds of uranium a year. The depreciation on the plant on an annual basis costs you more than the price differential between $75 a pound and $100 a pound. So also, although $75 a pound is the current incentive price, I'm not saying it's going to, but I could easily see the price of uranium going to 100 or 110 in the spot market. I don't use that in most of my pricing metrics. My matrix now starts at $60, which is the incentive price for existing production. The total cost of existing production, including prior year write-downs, which is to say exploration expense, and cost of capital, not just all-in sustaining cost. My second price is the term price today, $75. You can lock in a $75 contract with a $70 floor and escalations based on market, which is to say you can lock in an average of $75 in the term market today. So that's my current price. But I'm running myself a $100 price case too, because I don't see a $100 term price as totally improbable. And if you give yourself the upside of a $100 term price on any of Cameco, Kazatomprom, Paladin for that matter, or Nexgen Fission, you get some really truly gory net present value calculations depending on when you turn the deposit on. And you can justify some fairly stupid takeover premiums. I'm not saying it's going to happen, but I'm saying for 10 or 15% of my uranium portfolio, speculating on these possibilities is an attractive outcome when I already have my beta locked in, owning the Sprott Physical Uranium Trust in Cameco.
Do you, when we talk about how the uranium business side of things works, it kind of makes me jealous, because I wish I could have a 15-year offtake agreements for my croissants in the bakery and at a price above spot. That'd be awesome. But no, what do you think the catalyst will be, though, to get those stocks to come back to closely following the price?
I couldn't care less. I actually couldn't care less. I'm delighted that you have a bakery so that you can look at Cameco from the point of view of an actual business. Yeah. Too many people in your position view stocks as floating abstractions, which is to say narratives uncontrolled to reality. The fact that you understand that having a floor price for your croissants locked in for 15 years is a good idea puts you ahead of your competitors who don't understand that future pricing and future cash flows, future margin is an important investment consideration. Most people who you're competing with follow the ethos, got a hunch, bet a bunch, which means over time, if you are able to equate uranium to croissants, you're going to outcompete them. You're asking me how long people will remain illogical.
Yeah.
And I think the answer to that is to the end of time. But there's a variability in the lack of logic. If your readers followed the book selections that I gave them around The Intelligent Investor by Ben Graham, they will remember the chapter called Mr. Market. Mr. Market is your partner in your investment business, and he's a manic depressive. He's illogical because one day he wakes up and he loves the world and he loves your business so much that he's willing to pay you twice what it's worth. 6 months later, he wakes up and he's depressed and he hates the business so much that he's willing to sell it to you for half of what it's worth. A speculator's job then partly is to take advantage of Mr. Market's bids and asks. and understand that the market will be illogically depressed like it was a year and a half ago, and will become illogically optimistic like will happen a year and a half from now, or 2.5 years from now, or 3 years from now, 3 or 4 years from now. Anticipating when and how the market will be illogical assumes that you're a better social commentator or sociologist than I am. I just know that it will happen. And I'm not smart enough, or at least not geared enough to human psychology to understand when and why.
I do hope you're right, though, and my wife is also hoping that you're right, that eventually what I understand about croissants is going to matter for uranium. I'm going to try and explain that to her. I hope she listens.
Put her on the phone. I can get it across to her in a minute.
It's a world in and of itself. What's happening in uranium. I appreciate these discussions because they show you how different really the sector is. I also want to talk about how you value some of the other companies. So you mentioned a couple of names here. Maybe we can go through some of the rankings on some of these companies. So for people, by the way, who are listening and are wondering what these rankings are, and who want their portfolio ranked by Rick Rule, you can go to ruleinvestmentmedia.com. It's right on the front page. If you scroll down, you can put in your portfolio. It's free. Rick is going to get back to you on email. And but so Rick, what I want to do here is maybe another promotion here to your previous employer, Sprott, who's recently launched the URNJ ETF. I don't know how you feel about that, but it's got some interesting names in there. It starts with like big names like Nexgen, Paladin, Energy Fields. I'm seeing on here. Let's start broadly because there's many on here. But which one of those companies ranks the highest, which for you would mean the lowest number?
The highest of the developers I have right now is Nexgen Fission. I'm doing work on both Lotus and Paladin right now. I demoted everybody other than Kazakhstan, Kazatomprom, Nexgen Fission, and Cameco from 4 to 5, based on the fact that all their stocks doubled and tripled. Partially, this is a function of price. I had some, and still have some, companies in my portfolio that are decidedly more speculative, that are developers. And they're developers that don't have investment grade balance sheets. So they're going to have to develop their projects on a project specific capital market without the benefit of forward sales contracts. These guys are at a real competitive disadvantage to investment grade companies that can enter into counterparty agreements in the term market and use that to secure cheaper financings. So I've degraded all of those. Now, what I'm trying to do is do a deeper dive into companies that I think might have the ability to use credit enhancement to have a major insurance company guarantee on time, on budget completion of their deposit, so that they're able to use that counterparty guarantee to enter into offtake agreements. I've seen this happen in the oil and gas business before, where companies can use forward sales to finance construction costs by having credit enhancement. It means that they're not prime rate borrowers, they're prime plus 1.5 borrowers, because the insurance company takes 1.5 for the guarantee. What it means is that their cost of capital is 8% as opposed to 16%, and that's very, very useful. This may be a deeper dive than you're interested in having with regards to security analysis. But people who compete with me, whose ethos has got a hunch, better bunch, have got to understand the level of the competition that they're getting involved in.
Do we have those companies though? Like, do we have insurance companies that are going to do the work on uranium specifically? Okay.
Yes, and if it isn't an insurance company, I think it will be an insurance company. But if it isn't an insurance company, it could easily be a commodities trader like Glencore, Trafigura.
Yeah,
there are financial intermediaries
I can
who,
see
if they
Glencore.
see a fairly riskless 150 basis point premium,
Hmm.
if they see a deposit that built is going to be worth $3 billion, and they can make 1.5% betting that it can be constructed for $1 billion. And if they don't, they get to foreclose it. There are people who are both able and willing to take that risk.
Hmm. Sounds like you would be one of those people.
It's just that the quantum of the exposure is greater than the quantum of my capability. The answer to that is yes, but I don't have the balance sheet to guarantee $1.5 billion construction. If I did, I would.
But so you make a that's a statement in and of itself. But you make a good point about people understanding who they're up against, and that's making me think. Do you even think it's doable for most people to pick their own stocks in a sector? Because it's challenging, and failure is not only the norm, but it should be the expectation. So why not just go
And
for the physical?
Antonio, I've changed so much about that. I used to believe that the best money manager for an individual person was that individual.
Hmm.
But what I've learned is that many people won't do it. And if you won't do it, you can't do it, you shouldn't do it. My thoughts about ETFs were similarly prejudiced. When I looked at ETFs in the past, I said, well, God, this guy's charging me 40 basis points. And a third of the companies in the ETF are companies I wouldn't own with a straight face. Why would I want to pay a fee to own lousy companies? The reason is that if you identify beta in a sector, or if you're willing to take risk to generate alpha in a sector where the beta is built in, uh, taking a risk without having to spend any time is worthwhile. It might be that the highest and best use of your time is selling croissants and doing broadcasting rather than doing deep dives in uranium. And in that circumstance, if you believe, like I believe, that the uranium bull market has time left to go, then what you do, rather than spending the scores of hours that I'm going to spend on deposits and financial models, uh, you can allocate risk in your portfolio. You can decide how much of the spot physical uranium trust that you want to own. You can decide how much Cameco you want to own. You can decide how much URNM you want to own, and you can decide how much risk you want to take with the J. And you can devote the rest of your time to increasing the circulation of your podcast and selling croissants, two things that you absolutely can control. What I've learned is that for investors who are starting out, who have limited means and limited time, that is to say, they have families, they have businesses, they have jobs, and they're not so crazily driven as I am in the topic, that they are better off investing what they can afford by way of financial risk, and using the time and the emotion in activities that they can control better. So I very, very much advocate establishing a uranium position, deciding what size your uranium bucket in your portfolio is going to be, and then deciding how you allocate that bucket, how much absolute risk you want to take in the juniors, how much of it, if any, you want in the developers, how much of it you want in the seniors, and how much of it you want in the physical. I think that's an important discussion.
Sure is. And you often say that you should not own more stocks than you have hours to spend on those stocks in the month. Do you think that's maybe a little bit too aggressive too? Like I feel like I need to have five hours per week on each stock that I own, which is why I only own a handful.
I don't think you need to do that, but I think there is an argument. I've had a lot of pushback on it from people. And I'm beginning to think that there is room, if you're willing to take the headline risk around the economy and the commodity, that you forego that hour per stock per month, buy the ETF, save yourself 15 hours a month, and use that 15 hours per month at your basic business. That doesn't hurt my feelings. It's too inelegant for me. Uh, but I'm old, I'm fat, I'm experienced, and I'm rich. And I also enjoy the process. So for me, I don't have to spend the time understanding how to do the analysis around stock by stock by stock. But for somebody, let's say somebody with $100,000 portfolio who has a job, all those types of things, they're gainfully employed, they do well with their day job. The idea that they would assign $10,000 to uranium and have some of that money in ETFs and then just go on about their life has merit. It has real merit.
Another good point that you should maybe weigh the effort. That's maybe a philosophical point, like how much effort versus how much money you're investing in it. Because indeed, if it's only like 2% of your net worth and it doubles, but the total return for you is like 2% in total. And so was it really worth it, all the stress? And oftentimes I see like 80% of my effort going in what brings me 20% of the money, and then 20% goes into what brings me 80% of money. And if it were the other way around, I'd be in a much better position. But so sort of realizing that, or like realizing it is easy, but doing it in real life is hard. That's one point. So I sort of at the beginning, I kind of said that I was disappointed at some podcasts for hijacking the conversation and talking about what they care about, but I've also done that on here for myself. So let's maybe address that and go back to talking what you want to talk about. What do you think is today what uranium was when we first talked about it in 19 or in 20?
I don't think there's anything that's as attractive as uranium was. Uranium hit all my touch points. It was hated, which I like. More importantly, it was an industry in liquidation. The selling price for the commodity was such that if the commodity price didn't go up, the material would be unavailable and the lights would go out around the world. There was an inevitability of that in uranium, which I don't see anywhere else. From an investment perspective, I continue to believe that carbon-based fossil fuels are hated and they're attractive. What's missing is that the operating margins in fossil fuels are high enough that the prices don't have to stay up or go up, pardon me, for the industry to be solvent. What's amazing about the oil and gas industry in particular, however, is that it's in such high political disfavor and such low popularity that despite the fact that the industry is enjoying record high cash flows, those cash flows are cheap in the market. And the industry is underinvesting in sustaining capital. The politicians are telling the oil and gas industry, your business will cease to exist in 2032 because we're going to put you out of business. But they can't. They won't put them out of business. All they're doing is constraining the supply of capital to and the popularity of a business that will continue to be a very good business till 2065 or 2070. Specifically, the oil and gas industry is underinvesting in sustaining capital to the tune of about $1 billion a day. That underinvestment today constrains their ability to produce at today's level 2 or 3 years from now. In other words, the big thinking politicians, the Bidens, the Trudeaus, the folks who run the EU are paradoxically guaranteeing higher oil prices for a longer period of time. So the question becomes to find those companies that are investing sufficient sustaining capital to maintain their productions 2 or 3 years out when their peers' production falters. Those companies have names. The recent acquisition of Hess by Chevron and Chevron's commitment to maintain both sustaining capital and new project investment capital around Hess's Guyana assets guarantees that Chevron will be a producer of increasing volumes of oil and gas, even as their other competitors falter. And Exxon's acquisition of Pioneer guarantees the same thing. Now, what's missing with this thesis is simply the fact that oil is already priced at a price. It doesn't have to go up. But U.S. natural gas, a very different point could be made. The arbitrage between the BTU price of American natural gas and the price of that same natural gas in Asian or European markets, the delta is spectacularly high. And so I think a circumstance where U.S. natural gas reprices higher, if I think the oil price holds, which I do, is a very high probability. So there you look at a gas-centric producer whose share prices are depressed because the U.S. natural gas prices are depressed because we're producing so much natural gas as a byproduct of oil production. Names like Devon, names like Equitable, widely hated names, fossil fuel producers with depressed cash flows. Love it. For an investment quality portfolio. These aren't speculative names. These are high quality names.
It's
a different place that one might look if one's really a glutton for hatred and punishment, as I am, would be the coal business. I find it ironic that even in my favorite green whipping boy, Germany, I see them tearing down a wind farm to do pre-strip for a coal mine. Coal is so deeply out of favor, and it's so popular among consumers. The dichotomy between the price of coal mining assets and the amount of cash that they generate is astonishing. It's truly astonishing. Now, I know that most listeners, particularly your age, will ignore this because the narrative around coal is as bad for salamanders. And, you know, that great energy physicist Greta Thunberg doesn't think that there's a place for it. Glencore, a big mining company, roundly hated, bought a 40% interest in a coal mine that they didn't already own. They own the other 60. It's a mine with 30 or 35 years worth of reserves left, and they bought it for 1.5 times trailing cash flow. This is truly a stupid circumstance, a wonderfully stupid circumstance. The narrative is, well, coal isn't going to exist because it generates carbon. Well, Germany's choice right now is coal or freezing. Those are the two choices. What choice do you think German ratepayers and German voters are going to make? They're fine to have other people freeze. You know, they'd love to see the Belgians freeze or the French freeze or the British freeze, but the Germans don't want to freeze. The Chinese and the Indians have a choice between burning coal or having the lights go off. Let's look at a couple statistics just for fun around coal. The world has invested over the last 40 years $5 trillion on alternative energy. Some of it has been well spent, but much of it is building solar capacity in Northern Europe where the sun doesn't shine. And as a consequence of spending $5 trillion over 40 years, we've reduced the market share of fossil fuels from 82% to 81%. Yes, the market's expanded for both fossil fuels and for alternative energies. How much money would it take to reduce the market share of fossil fuels meaningfully? And by the way, where's that money going to come from?
Me?
It ain't going to happen. It just is not going to happen. When you look at carbon from a non-American, non-European viewpoint, when you look at it from a frontier and emerging markets viewpoint, you see things very differently than we do. The EU and the United States believes that carbon outputs should be established per nation. People in frontier markets believe that carbon should be allocated per capita, not per nation. And places like India and China, which are fairly small carbon users that have a lot of people, should have some upside in their carbon use, while carbon conservation should take place in the West. People in frontier markets also point out that part of the theoretical problem of carbon is existing carbon loadings. which is to say it's the addition of carbon to the atmosphere in addition to the carbon that's already in place that's the problem. And people in emerging and frontier markets point out that basically all of the legacy carbon in the atmosphere happened in Western developed nations. And so they suggest that the burden for carbon in the future should be felt in the West. Western voters right now are in the lead with regards to this anti-carbon ethos. If the burden of carbon was actually shared fairly, based on historic loadings and per capita consumption, that would argue for sort of, €5 per liter gasoline. It would likely result in electricity prices that were 3 times today's electricity prices. So tell me, Antonio, how would Belgian voters or German voters or Austrian voters look at a quadrupling of their energy prices relative to their feelings for coal or oil or gas? There's 1 billion people on the planet, Antonio, that have no access to electricity whatsoever. They want to live like you and I live. They understand that the carbon problem was created by you and I, not by them. And they have no interest in them being part of our solution. And we, while we have a narrative reaction to the problem, have much less economic willingness to support the narrative than we've shown our politicians in the past. All of that means that peak demand for fossil fuels, particularly oil and gas, is likely to occur in 2060 or 2070. Peak demand for coal is likely to continue until we've built enough nuclear power plants around the world that we can provide base load power without burning coal. That's likely to take at least 20 or 25 years. And that means that investments in fossil fuels are much better investments than the market believes them to be.
And really all you got to do is look at the levered free cash flows that some of these companies generate, like Exxon and Chevron. I think Exxon generates like $50 billion. I'm not exaggerating. It's like $45 or $50 billion in levered free cash flow. They can buy Cameco with cash 3 times over. So stuff like that, when you talk just in the size of the market and the quality of the businesses.
When the big thinkers of the world, the big financial analysts of the world look at Exxon, they believe that peak oil demand is going to occur in 2032. And they take the net present value of the future cash flows. They they don't risk them, pardon me, they discount them at 5% or 7% or 10%, and they assign no terminal value to the asset. What you'll find is that the terminal value of Exxon after 10 years restarts at the same level it started. That is to say, its net present value 10 years from now will be the same as its net present value today. And the idea that you aren't assigning them a terminal value to the asset when peak oil demand occurs in 2065 and then tails off for 40 years after that is silly. It's a mistake that's driven by narrative, not by arithmetic or physics.
All right. So as I said at the beginning, Rick got called in earlier, so he had to leave earlier than expected. But to compensate for that, I've taken out a clip from an older conversation that I had with him where he talked about how to deal with, like, how to deal with being a contrarian. How can you be a good contrarian, basically? So buying and selling assets that are out of favor. How do you do that? And more specifically, how to weigh the probability in your favor. And I think that applies very well to this whole conversation that you just listened to. So let's listen to that as well.
You make really big money by buying stuff that's out of favor way too early. And when it comes into favor and you're enjoying these rapid price escalations, you come to understand with some experience that when the narrative itself becomes popular due to price, that the narrative is less valuable. When the price of uranium was $8 or $10 a pound, I believed it had to go to 30 and it could go to 40. And it went to 130. Really, from my point of view, everything above $50 was gravy. But every $10 increment in terms of price that the market enjoyed made the market itself more popular, which is to say nobody wanted to buy the stuff when the price had to go up, and everybody wanted to buy the stuff when the price had to go down. At the beginning of the exercise, Antonio, there were 5 public companies that had survived a 20-year bear market in uranium. 5. There were probably between 12 and 15 teams that could have been assembled to run a public uranium company. So if you have the availability between 12 and 15 teams, and you have 5 aspirants, the probability that the team that's running your uranium company is competent is pretty high. Mm. At the top of the bull market, there was the same number of teams. Enough time didn't elapse to train a bunch of new teams. So you still had between 12 and 15 teams, but you had 500 public companies that purported to be in the uranium business. So the probability that your company had a competent team was a function of dividing the number of teams, 15, by the number of aspirants, 500, which is to say the probability that your company was well run was very, very, very close to nil.
Mm-hmm. Do you have any specific examples maybe of stuff that you bought but then turned out wrongly or something along those lines?
No, I think if you examined from a cursory point of view, what you would find in the last bull market is that I sold too early. Not something I'm ashamed of, by the way. I ended up with a lot of money by my standards. And I took the lower risk part of the trade, which is to say, once the uranium price went through $40, which I figured was the incentive price for new production, I began to sell. There were a whole bunch of hot Canadian juniors that came out at a quarter and went to $1.25, and I didn't play. The pre-money valuations were often $20 or $30 million, while the net present value of the assets assembled was close to nil, which is to say I was paying $25 million for nothing. And the industry said I was getting in cheap. And the management teams were people who had failed in gold exploration, failed in oil and gas, probably failed in copper, and perhaps failed in the internet too, and were recycling their vehicles in uranium. So there was no reason from an expertise point of view to get involved in the game. There was no reason from a valuation point of view to get in the game. The only reason to get into the game was fear of missing out, which is something that even at that age, which is to say in my late 40s, early 50s, I was already not guilty of. So I would say that if the street looked at my performance in the last bull market in uranium, what they would say is he didn't sell too soon. He sold way too soon. But as you point out, most of the companies effectively went to zero. So what is way too soon? I made some money. I made what I would argue to be the rational and safe money. And I left the blow-off money on the table. And I hope I do that for the rest of my time on Earth.
Yeah. Somebody told me that you have to pay the greed gods before they come and take it themselves.
I think that's very accurate. And I think it's a lesson that you learn with age. What happens is very pernicious, which is to say, particularly if you believed in the narrative before other people did and you had your faith tested. When the narrative comes true and you're starting to make money and feel smart, the price action that you see in your own mind justifies the narrative. And you come to believe more in it, even as it's less valuable. When the price of uranium went from 10 to 40, the fact part of the narrative was already done. It doesn't mean that the price of uranium couldn't go higher. In fact, it did to 130. But people forget that markets work. There's a lag. But when the market went to 130, there was no reason for it to go up and every reason in the world for it to go down, which of course it did, falling from 130 to about $80 before the Fukushima event took out the demand side for uranium. So for me, I began to be a fairly aggressive seller when the price of uranium no longer needed to go higher. and I would do it again. What I tell people in terms of the sell decision is, first of all, review why you bought a stock. And review when you buy the stock, what you think the probability of the favorable outcomes would be, and why, in a very broad sense, what price you think something can go to. If I look at a gold stock, I think the probability is in 2023 that gold goes through $2,000, maybe to 2,100. And so when I'm running a pricing metric on a gold stock, I'll run a downside case, which is to say $1,500 gold. I'll run a present case, $1,900 gold, and then I'll run a $2,200 valuation. If the gold price does go to $2,200, and I have a sense what the net present value of the free cash flows of the company at $2,200 would be, if the price of that stock escalates substantially beyond what I believe to be fair market value, I begin to be a seller, regardless of the technicals, regardless of momentum, regardless of any of that. For me, when the reason to own a stock begins to go away, the stock needs to begin to go away. And that's in a successful case. In an unsuccessful case, it's much easier. If you believe that XYZ has to happen in the uranium market, and the uranium market, for whatever reason, doesn't perform, perhaps the pace of Japanese restarts isn't sufficient to accommodate supply overhang from Canadian and Kazakhstani restarts. And perhaps what happens is that you don't need the incentive price in uranium because there's enough uranium in the market to accommodate demand. I don't believe that to be the case. But if that gets proven to be the case in 2024, I will need to reset my valuation targets.